Hello and welcome to this very special episode of Money View from the Top. Joining me today is a market guru. For 30 years, he has tracked and invested on behalf of millions of investors across different roles with the mutual fund industry, seen many ups and downs, and couldn't have asked for a better person in these testing times to speak to our viewers here at Daily Hunt. Thank you very much, Vetri. It's always been a pleasure talking to you over the years. And I'm very happy that you could make time for the young viewers across Bharat of Daily Hunt, millions of them tuning in to listen to you. My first question to you, you've seen, as I mentioned, so many cycles in your life of ups and downs. How different is this cycle where there is so much of global turmoil? There is talk of recession in global developed countries. Experts say India is a shining example. We'll talk about that in a bit. But enormous volatility. And, you would recall when you started your career or when I started mine around the same time, if the Sensex was 100 points down, we called it a crash, and percentage terms, probably it's the same today. But when people see 1,000 points up and 1,000 points down, there seems to be a sense of fear. There seems to be a sense of, what's really happening. So I know it's a long question and I expect a long answer. How are you constructing the current scenario? If you could educate our listeners on that.
Sure, Vivek. First of all, glad that we could connect. It's been a long time. Glad to see your new avatar. And, we've taken a look and, great to see the kind of, content you're putting out there. And certainly that should help guide investors all over the country, right? Because I think the wonderful thing about this digital medium is it can pretty much touch anybody and everybody in any part of the world. So, I'm glad that I can be here and have this conversation with you today. Now, just coming down to the issues which seem to dominate the headlines and the news flow, and obviously it's also contributing to some level of volatility. Now, in your opening comments, you did say I've been around 30 years, which also means that I tend to be a little bit blase about such stuff. And honestly, Vivek, there is always such stuff going on, right? Now, I say this with all due respect to the fact that I know there have been a large number of new investors who've come into the markets over the last 2 years. And certainly over the last 5 or 6 years, there's been a dramatic surge in the kind of investor base that the industry has. But I must say, there is nothing new about this kind of news flow. If I were to, point you back to the long-term returns that investors have earned from equities over the last 10 years, 15 years, keep in mind, this includes periods like the boom of 2003, 2008. It includes the never before seen financial crisis of 2008, 2009, the entire GFC period. It includes a very difficult period for India. Go back and Google it if you were not investing, which was called the policy paralysis of 2011, 2013. Then we come to the period in India again, where there was a tremendous cleanup required of the entire banking and financial system, where loans had to be written off, banks had to raise capital. And finally, we get to COVID in 2020, which again is something that none of us knew about, because the only time we read about it was a passing reference in some textbook to the Spanish flu epidemic of 1918. So the point I'm really trying to make is that when you look at the case for investing in equities today, and you see that over the last 10 years, 15 years, this has been one of the best performing asset classes, not only in terms of having created wealth for investors, it's given protection to them against inflation. Of course, it's volatile, but during these trying circumstances, it has generated value. Now, when you look at the kind of events we've experienced over the last 10 to 15 years, and then think about today's events, then, the question you should really ask yourself is, how much does this really matter in the long term? Because we've seen far worse in the last 15 years, and you've still got, results from the equity markets, which suggest that it is worth tolerating this volatility. It is worth tolerating this mark-to-market risk that you are exposed to in equities, because the long-term returns are sustainable. Now, are we facing a new set of challenges today? The answer is yes. But I guarantee you, if we were not facing this set of challenges, there will be another set of never seen before challenges which will come down the road over the next 2 years or 3 years. So, maybe there's further, discussion we can have around some of the challenges the world faces today, inflation, the Ukraine conflict. But, maybe I'll leave that for later. But my simple point is, nothing we are seeing today is unusual. Challenges are part and parcel of equities. The message of the last 15 years is stay the course, and good to read the headlines, but don't allow that to impact your asset allocation or your investment strategy.
Vetri, the good news is that the whole concept of SIP seems to be gaining good ground. I mean, I know that we can do far, far more as a country, but the fact that month on month, we are seeing record inflows and, crossing new benchmarks, that's been, I think, a big shift in the way Indians are looking at investing in equities. So for an SIP investor, and you made the point about 10, 15 years, what kind of a wealth creating opportunity does India hold for the next 10 to 15 years? Because, and I'm asking this because many of these people have come in over the last couple of years. So if you were to look at the next 5, 10, 15 years, not asking you 1 year, 2 years, but the next 15-year Indian equity story, or the next 10-year Indian equity story, is there good wealth to be made for these whole new SIP investors who came in the last couple of years?
Great question, Vivek. Now, first of all, let me put it like this. I'm not a soothsayer, but if you're an equity investor, you must have a broadly optimistic view about what the future holds. I'm very optimistic about the kind of progress the country can make over the next 10 to 15 years. But at the same time, I am cognizant that eventually the returns that you earn from equity markets are a function of the discipline that you follow in terms of valuations, and it is driven by the earnings outcomes that you are likely to experience over the forward period. But let's step back and say, how should an investor think about planning for the future? The way we do this, Vivek, is really to start with a financial planning mindset. India has an espoused strategy today of containing inflation within a 4 plus or minus 2% range. That's your target number one. You want to protect your capital against, the wear and tear of inflation. Now, what does that mean for what we would call the risk-free rate? The risk-free rate is the rate at which you could invest in government securities. You're lending to Government of India. There is no credit risk involved in that. So if we believe that India could achieve a 4 to 5% inflation range over the next decade, then really there is no reason for the risk-free rate to be significantly above 6.5 to 7.5% range. Right? So that's the starting point. You can protect yourself against inflation by investing in Government of India issued securities, which could give you 6.5 to 7.5%. But now the question is, you really want to create wealth for yourself. That's why you come to equities. Now, I don't want to get into the theory of it, but very simply, we would say the historical risk premium that you can get by investing in equities is about anywhere between 5 to 6%. Now, what that means is that you add that number on top of the risk-free return. In your mind, you should be modeling about a 6 to 7% return from fixed income instruments over the next decade, and let's say 11 to 12% return from equities over the very long term. So when you make your financial plan, these are the building blocks. 4 to 5% inflation, 6.5 to 7.5% GSEC, as we would call it, yields. And on top of that, equity returns, let's say at about 12%, keeping in mind the risk premium. So that's the way you create the framework. Now, you mentioned SIPs. That's been a phenomenal story over the last 6 years. Today, we are receiving almost 12,000 crores a month by way of SIP. That number, Vivek, is up 4x in 6 years. Unbelievable traction. Now, I'm delighted to see that because, my memory of 2008, 2009, when I was also in the mutual fund industry at that point of time, was most people calling to say, shall I remove my money from mutual funds, because of the GFC, the great financial crisis, rather than continuing to stay the course and investing as the market got cheaper. The beauty of the SIP is that it evens out the volatility by ensuring you're investing at all points of time, which means at some point you may invest when the market is expensive, but crucially, you will also be investing when the market is cheap. So I think today there's a lot more stability in that pipeline. But when you model for equity returns, think about this 4%, 6%, 12% as the framework to think about the kind of returns you can experience. Point number two, think about, I would say, a 15 to 20 year time frame when you're making these plans. Finally, is it possible for you to earn more than 12% from equity? Of course it is. But I must say there are a few preconditions for you to be able to do that. If you're an excellent stock picker, which involves a lot of time that you must devote to picking up the basics of analysis and investing, you must have the emotional quotient, which many would argue is more important than the intelligent quotient to be a successful investor. And it's not me saying that, it's Warren Buffett saying that investing is more about EQ than it is about intelligence quotient. So you must have the time, you must have the ability, you must have the EQ. If you have all of that, certainly your returns could be better than 12%, simply because you're a great stock picker and you're picking businesses which can give you better returns than that. Now, there is also a second possibility. You're great at asset allocation decisions. You know when the markets are cheap, at such points of time, you raise your asset allocation to equity. You know when the markets are expensive, at such points, you reduce your asset allocation to equity. By doing this simple discipline based on valuations, and that is not market timing, you could once again improve your returns above that 12%. Finally, there is another way in which people try to enhance their returns, which is by a very active trading strategy, right? Buying today, selling tomorrow. My own sense is that very few people are actually successful at doing that, particularly as market color changes, as market volatility level changes. I admired the skill of the few people I know who do this successfully, but I don't have it. I don't recommend it to anybody, and certainly don't try it with leverage. But is there a way to improve the equity returns above 12%? It will have to come by a combination of this. Are you a great stock picker? Are you great at asset allocation? Are you great at trading? I would say point number three, 99% of the people are going to be lousy at that. Your best chances are in strategy one and strategy two to try and enhance your returns. But while modeling a financial plan, the earlier numbers that I said are most relevant. 4 to 5% inflation, 6 to 7% risk-free yield, 12% equity. That's the way you should model it. And when you do an SIP, you're taking the discipline of the SIP to manage your emotional quotient, and therefore it should more or less help you achieve that 12% return.
Vetri, we are speaking after many years, but I remember in our previous interviews, we used to 5, 7, 10 years ago talk about passive investing and how index funds are extremely popular the world over in developed markets, but are yet to take off in India. Since then, a lot has changed. And, even as we speak, there is a flurry of index funds or passive funds, as they're called, being launched by various entities, pretty much everyone in the mutual fund industry. Now, I know you are an active fund manager all your life, but again, I'm asking this more from an educational point of view, that for a beginner, and I have two questions here. One is a person who is wanting to start out. Of course, we've always said that the first thing you need to do is find a financial advisor. But supposing you don't wish to at this point and you want to start small, should it be passive, buying an index versus buying an active fund? And if it is an actively managed fund, which category, according to you? Because again, that's seen so many changes over the years. There was a time when we used to speak, there were 5,000 plus schemes. So while there's been some rationalizing, but at the same time, the regulators come out with far more simpler categories, but there are a fair amount of categories which can often confuse a beginner unless you go through an advisor. So what would you recommend to someone who's listening to you and wants to participate in the India story, equity story? What kind of a category approach should one take?
Sure, Vivek. As you know, I wear the hat of Chief Investment Officer at UTI Asset Management today. So I not only oversee fixed income and equity. Within equity, I oversee both active and passive. So, I have many hats that I get to wear these days. And really, the very simple answer to your question is that I think passive is now clearly a fact of life in India as well. And really, what we tell investors, it's a question of active and passive. You need to see how you can use this in your investment strategy. Now, if you remember in the previous question, I talked about ways in which you can enhance your return above that 12% mark. Now, when I say 12%, I'm typically referring to the returns that the asset class as represented by an index can give you. If you can pick the right active manager, they could create an alpha as an active manager, and therefore that would further enhance your returns as an investor. But my simple message, and you asked this on behalf of the young listeners today, would be please think of active and passive. It's not an either or question. You should actually do both. You should figure out what mix of these two works best for you. The beauty of passive is that what you see is what you get, right? You will pretty much get the benchmark return. You are not exposed to the risk of choosing the wrong fund. You will also not get the benefit of having choosing the right fund, right? Because if you pick the right fund, the alpha might be 3%, 4% higher than the benchmark. It could be 2% higher than the benchmark. And that 2% number, when you compound over 15 or 20 years, can actually lift your outcomes very, very significantly. So that is why I believe that both have a place in an investor's portfolio. But, we at UTI for a few years now have particularly been messaging young first-time investors. We call them first-time jobbers, meaning, first time they're in a job, they've got some investable surplus, and they're looking how to invest it. And we say the easiest thing for them to do at the outset is just start with an index fund, right? You're never going to have buyer's regret on that fund. You can invest in it today and you can continue investing in it 20 years from now. Whereas on the active side, you will require a little bit more of regular due diligence and follow up to make sure that you are in the right strategy that you had chosen, and it is still being managed the way it was being managed when you had taken that purchase decision, perhaps way back in the past. So for beginner investors, we would strongly recommend the first sort of interaction with the market is ideally done through a passive fund. And even within passive funds, Vivek, I would say today we have the plain vanilla index funds, the Nifty Next 50, maybe the top 100 index funds. And then we have what we call the smart beta funds, right? Which could include a momentum index, a value index, a low volatility index, so on and so forth. I would say cut out even the smart beta, cut out the sector passive funds. Simple Nifty Next 50, top 100 companies, that's the go-to at the outset. As you get more comfortable, as your knowledge of the market increases, then you could look to do things outside of that. So first step, index, I think makes a lot of sense. As you are able to put more time into research, you could consider picking an active fund because the alpha can significantly improve your overall outcomes over time.
Vetri, are your fund managers buying at the current levels, or are they sitting on cash?
Very good question, Vivek. I think this goes back to investment policy as we've defined it at UTI Asset Management Company. We are very clear, and the way we think about this is that our investors, along with their advisors or acting on themselves, have already taken an asset allocation decision when they choose to invest money with us. So if you are going to make an allocation into our equity scheme, we are going to do our best to make sure that it is fully invested in equity at all points of time. We will have the best possible portfolio that we think really makes sense over the long term, always being managed in that portfolio. But very simply, we don't take cash calls. So if I look over the last 5 years, our average cash balance in the portfolio is typically 2 to 3%. There will be literally very few days where it has either gone significantly below that and stayed there, and very few days where it's gone outside that range and stayed there. So we run fully invested portfolios. We do not encourage fund managers to take cash calls, in the simple belief that it's our investors who have given us that money to be invested in equity, and therefore we will be there. Now, those investors who would like to choose a level of asset allocation, there are other products available to them. There are hybrid schemes which different levels of allocation to equity. There is a multi-asset scheme where we say we have our own model for asset allocation. We will take the equity allocation up and down based on those models. So if you want us to take the asset allocation decision for you, then come to those strategies. But in what we call the pure equity schemes, we will not take cash calls. We will run fully invested.
Vetri, I know that you and your team don't invest in sectors, and this is something you've been saying for years. But since we don't discuss individual stocks, what are the 3 or 4 key sectors or areas or themes that you are bullish on over the next 3 to 5 years?
So good question, Vivek. And let me just elaborate first on why I've always said stocks over sectors. When we look back at the data and when we see our own performance, I don't manage funds anymore. I let go of active management when I took the CIO role. But when I look at my own sort of track record over time doing the data analysis, what we find is that it is actually the stock selection which over time is the biggest contributor to alpha. Sector selection plays a role, but there are very few people who can successfully demonstrate. And even within that, you will find that the contribution of stock selection actually tends to be much higher. So we are coming from a place where we recognize what has been the source of the alpha that we've created over time, and which is why we say in the long-term stock selection, more important than sector. But you're right. I can generally talk about the themes where we think are attractive today. We certainly think that the financial services sector is in very good shape, particularly the core lending business. These are some of the best balance sheets I've seen in the lending businesses, and particularly I would say, the top 5, maybe top 7 lending institutions in the country. Excellent balance sheets, well placed to power credit growth in a country where credit as a percentage of GDP still remains quite low. Right? I mean, India's credit to GDP is still, in the 60% or slightly less than that range. Whereas you look at most other economies as they move to higher per capita incomes, credit to GDP is, 100% and higher. So I think there is a structural runway for growth which is available in that sector. There's consolidation and there are very strong balance sheets with the top players. So that's an area I'm, very positive about. From a more contrarian perspective, simply because, in the markets, it's not a question of what's the most high growing sector in the next few years. It's a question of where is the market sometimes got an anemic view of what growth might be, whereas, the potential for growth might actually be better than what the market's own anemic view is currently. And in that context, we think the domestic pharmaceutical healthcare sector is very interesting. It's been underperforming for the last 2-3 years now, but we are seeing signs that individual managements have cleaned up their act together quite significantly. And we think this is again an area where structural growth can actually do much better. Why do I say that? For 2 reasons. As incomes grow higher, people are able to spend more on high quality medication and healthcare facilities. Equally, as the economy grows, unfortunately, Vivek, this is a reality of life. There is an increase in what we call lifestyle conditions, right? And these are all, unfortunately, medical conditions which now require you to undergo a lifetime of medication. We are not talking about the 5 days of antibiotics and you're dusted, right? You've got diabetes, you've got a heart condition, you've got a CNS problem. It's a lifetime of medication which lies ahead of you. And therefore, these chronic conditions, as we call them, we think are likely to be seen in larger numbers among the affluent parts of the population. And that is a very attractive opportunity for the domestic pharmaceutical sector. When you think out, as you said, over a 5-year period, consumption has been an area which has been at the heart of the India growth story. We continue to think that is an area which remains attractive. Now, valuations over there for many of these businesses have traditionally been richer than market multiples because these companies tend to be great in terms of their ability to generate consistent cash flows, high return on capital, high return on equity, and therefore they typically tend to trade at a premium to the market. Having said that, this is an area where we think the structural growth prospects remain fabulous, and therefore at the right valuations, and even in our portfolios today, we hold these as long-term structural growth, and we wouldn't want to back away from them.
Always a pleasure talking to you, Vetri Subramaniam. Thank you very much for taking time out. I know these are very challenging times for you and your team and for everyone who's associated with the market. You took time out to speak to Daily Hunt viewers. I truly appreciate that. I look forward to many more conversations with you. Thank you very much.
Thank you, Vivek, and delight to connect with all the viewers of Daily Hunt.
Thank you.